Ever wonder what it looks like when the smart money makes a huge, high-stakes bet? Well, today we're going to pull back the curtain on a fascinating trade in a company called Eaton Corporation. It's a bet that adds up to $60 million. Yep, that's the notional value on the line here. So what that means is that's the total value of the stock that this trade is controlling. Some big institution is putting all that capital to work based on a very specific idea about where this stock isn't going to go. This is a real heavyweight move. And that's really the heart of it. An order this big, it's a powerful signal. We're essentially getting to look over the shoulder of a financial whale as they draw a line in the sand. They're saying, with a ton of confidence, we think this is the bottom for this stock. So what is the actual bet? At its core, it's actually pretty simple. They're betting that Eaton, ticker ETN, is going to hold its ground. They believe that even if the stock takes a hit, it's not going to fall more than about 11% from where it is now over the next month and a half. And they're so confident that they are willing to buy $60 million worth of the company if they turn out to be wrong.
Okay, so how do you actually build a bet like this? What are the mechanics? Let's break down the blueprint. The tool they're using here is a specific kind of option.
It's called a cash-secured put. Now, don't let the name intimidate you. Think of it like this. You're basically telling the market, hey, I am totally willing to buy this stock if it drops to a lower price. And for that promise, you have to pay me right now. So you get cash in your pocket immediately, just for agreeing to maybe buy a stock you like at a discount. Pretty cool, right? All right, let's get into the nitty-gritty here. They sold puts with a strike price of $300. That's the price they're agreeing to buy the stock at. Now, for making that promise, they instantly collected a premium, that's the upfront payment, of $2.70 per share. That payment actually lowers their break-even point down to $297.30. So they only start losing money if Eaton drops below that price by the January 9th expiration date. So we've covered the what and the how. But the most important question is always, why? Why this company? Why this price? And why now? The logic here is incredibly clear, and it really stands on a solid three-part thesis. First up, the timing. And honestly, this is just brilliant. This wasn't some random date they picked out of a hat. No, it was chosen very deliberately for a tactical reason, to avoid a totally predictable storm of volatility. And this timeline just lays it out perfectly. The trade expires on January 9th, but Eaton, the company, doesn't report its earnings until the end of January. By setting it up this way, the trader gets to collect their money while completely sidestepping the risk that a bad earnings report could send the stock tumbling. It's like a built-in 3-week safety buffer. Just really smart. Okay, the second pillar is all about the quality of the company itself. This isn't a bet on some speculative fly-by-night stock. No, this is a bet on a solid business that they would actually be happy to own. Eaton is what some people would call a compounding machine. It's a leader in really critical industries. Think data centers, the power grid. So let's say the stock does fall, and the trader is forced to buy the shares. Well, they get to own this fantastic company at a net price of about $297. And at that price, it's trading at a really attractive valuation. It's just a great entry point for a long-term investment. The final piece of the puzzle comes from the stock chart. It's all about building in a cushion, a margin of safety, based on how the stock actually behaves in the real world. And that cushion is pretty significant. We're talking about 11%. When this trade was put on, the stock would have to fall more than 11% just to get down to that $300 price where they might have to buy it. So why does that 11% buffer matter so much? Well, for a steady, low-volatility industrial stock like Eaton, an 11% drop in just 6 weeks is a huge move. It almost never happens unless there's some kind of major market shock. On top of that, $300 is a big, round psychological number. The whale who placed this trade knows there are probably tons of other buy orders sitting right there, ready to provide a strong floor of support. So you put all this together, the timing, the quality of the company, the technical buffer, and it creates what the source material calls a win-win philosophy. There are basically 2 ways this trade can end, and this investor is happy with either outcome. It works like this. Scenario A, which is the most likely one, the stock stays above $300. The option just expires worthless, and the trader keeps 100% of that premium they were paid. That's it. Pure income. Then there's scenario B. The stock falls below $300. They're now obligated to buy the shares, but they get to do it at that discounted price they wanted all along. The outcome? They now own a great company, but cheaper than it was before. Let's just zero in on that income scenario for a second, because the return you get is actually pretty compelling. I mean, how much are they really getting paid for this 6-week promise? Well, if you annualize the premium they collected against the cash they had to put up to secure the trade, the return is about 7.4%. Now, for a commitment of just 6 weeks, that is a very, very solid yield. And to put that into perspective, this chart compares it to, say, a high-yield savings account. This strategy is generating way more yield, and it's all backed by a blue-chip, high-quality industrial powerhouse. And just to be crystal clear, even the bad outcome is still a win. The portfolio would now own a top-tier industrial company, that compounding machine we talked about, but at a fantastic price. It's just a really thoughtful two-pronged way to make a return. All right, so after taking this whole trade apart piece by piece, what's the big takeaway? What's the core lesson we can learn from this $60 million bet? Here it is in one sentence. The strategy is to follow the smart money to generate a roughly 7.4% annualized yield with a nice, comfortable 11% margin of safety on a company you would be happy to own for the long haul anyway. It's a strategy that's built on tactical timing, fundamental value, and a technical cushion. And really, that brings us to the final thought here. To sell just one of these put contracts, you'd need about $30,000 in cash to secure it. So the real question becomes, is this kind of win-win strategy something that could fit into your approach to the markets?